Let's talk more about what these rising rates might mean for equities with Bob Dahl, joining us this morning, Chief Investment Officer at Crossmark Global Investments. Bob, it's good to have you. Are you of the view, Bob, that yields have separated from anything regarding inflation right now?
No, I think the bond market and the stock market are waking up to the fact that you can't have a good economy, falling inflation back to 2%, and the Fed done or almost done and going to cut rates last year. That's nirvana. It's not going to happen. It's going to be one way or the other. And then Sarah's analysis, I fully agree. For a decade, we had the deficit going up, but interest rates falling. So interest expense didn't go up. Now with the debt going up and interest rates going up, all of a sudden that free lunch we've been eating for years, we're going to have to pay the piper. You put that all together and no surprise, we're at 475.
So what does that mean for equities? And are you paying any attention to some of the 1987 analogs where it really was a picture of stocks had rallied and yields continued to climb relentlessly up until October?
Yeah, so what I would say is that the probability of a financial accident certainly has gone up. When you move interest rates this far, this fast, we started to see some quality spreads widening. Look, I'm not forecasting anything. I don't know anything. But when you get this abrupt change, it often leads to that. And I think that's part of the rising required rate of return, if you will, and among the reasons stocks have gone from 4,600 to 4,200.
So how does this resolve itself, Bob? It doesn't look like we're going to get much action in Congress on that front. I mean, the Treasury Secretary isn't even seeing this as being pinned on worries about U.S. debt. So where is the resolution?
So on the government debt side, there is no resolution. We've got to live with this, which means slower growth, somewhat higher inflation, God forbid, higher taxes, hopefully someday some spending cuts somewhere. But they're all long-term issues, as you know, Sarah. In the meantime, the market's got to come to grips with, okay, how long can the economy stay good as interest rates are catapulting higher? Or do we have economic weakness and that dreaded word recession comes back into the vocabulary? And then we have to have an earnings adjustment. All we've had so far is a valuation judgment from a reset from 2021 PE to 1819 on this year's consensus earnings. 1819 times is still not cheap, as you well know. And so this 4,200 holds if the economy stays okay and interest rates stop going up. But if the economy weakens and earnings estimates have to come down, I don't know where we're going to get a double-digit percentage gain in earnings next year. So 4,200 is a lot more interesting than 4,600, but I think the risk is sadly still to the downside.
So where are you along here, Bob?
So I want to own companies that have earnings predictability, earnings persistence, good cash flow, reasonable valuations. The HMOs are an example there. Great stocks last year, struggled this year, starting to poke their heads up again. Those kinds of names that have some economic independence, if you will.
Bob Dahl. Bob, we'll keep it a bit short today. Good to see you. Check in soon. Thanks for the time.